why not ask him to present to us the zero DT? And I know it's a hot topic. It's in fact the latest rage for those who know how to trade options. And it basically means you're trading an option that's expiring the same day that you got in on it, more or less.
Well, it's you're actually trading on the last day when the option expires.
Right.
Yeah. So it's not just a day trade option, but you choose to trading an option that expire on that day. Okay. Can we start?
Okay. Yes, absolutely.
All right. Any problem with the presentation? You guys see it clearly?
If you want to maximize it, you can maximize it.
Okay, sounds good. 1 second. Not sure if it works. Does it max now?
Yep.
Okay, good. All right. So my name is Chen. Thank you very much for inviting me to OC Traders, and glad to be here. And it's been great wanting to find a group that's traders with similar interest. So today we're talking about zero DTE. I know it's been a kind of hot topic, and there's probably a lot of things that you may already know, you may not know. If there's any time you guys think there's question that you want me to answer, I'll try my best to help answer the questions. So
And if I see something in chat, I'll let you know.
Okay, sure.
Sure.
So the fundamentals of any trading principles on stocks is all about, from my perspective, is all about volumes, right? So anytime you have buy volume exceeding the sell volume, you start to get uptrend. Anytime you have a sell volume exceeding buy volume, you get downtrend. Anytime that they seem to be kind of, there's too much activity going on in my house then. Yeah. Okay. Is this better?
Yeah.
Okay. Good. Good.
You don't want to do full screen anymore?
No. Give me a second. Let me try that.
Oh, okay.
Okay. So what I'm trying to get to is establish the basis that price goes up when you see an increasing in buy volume, and price goes down when you see a decrease in buy volume or increasing sell volume, in the case. And this is an example of the charting signal I use every day to look at the options and underlying tickers. So the green shows buy volume, and thus the red shows net sell volume. To understand zero DTE, we have to first understand option, right? I understand that most of you should already know option. I hope I don't have to go into in-depth explanation what that is. However, the essentially is 4 type, right? 4 type of trade that you can do. Either you do a long call, and without going to overly complicated option strategy, I'm just simplifying into 4 primary cases. Either you long call, long put, short call, or short put. Agree? So if the price goes up in stock, right, the price of call should go up in a general concept. And the price goes down, then the price of the put goes up, so on and so forth. And if you're doing a short call, right, and the price goes, price goes below the call, the price point of call, then it should goes down. So okay, so what that really means is we have to understand the component which change the option price, and that consists of what typically people call the option Greeks. That's delta, gamma, vega, theta, rho, right? And what delta is the price of option change based on the change in price. And gamma is the price of option changes based on change in delta. Right? Think of it as a derivative of the price.
Second order, yeah.
And the price of the vega is when the volatility increase, then you see an increase in the option price. Theta is time to expiration. Rho is interest rate. So what that really means from the zero TTE perspective, there's only primarily three components that we mostly focus on, which is the delta, gamma, vega, right? Because theta at the last day of expiration has essentially no impact. You down to the minimum theta value. And rho essentially have no impact at all, right? So what that translates to the zero DTE impact is we have to observe when the price goes up and when the price goes down. Does it accelerate going up or accelerate going down? And if the range increase or range decrease from volatility standpoint. So that may help you to visualize and simplify the Greeks in terms of the price changes relative to what the option value is. Okay. Was there any questions? No. Okay. Let's see next. All right, so to understand zero DTE, we should first understand what a gamma wall is, right? Typically, most of the traders in options are option sellers. As a seller, your goal is to be profitable, and you are selling based on the support and resistance level of the stocks. So when I talk about gamma walls, I'm talking about the two price points which represent as support and resistance on the option chain. And they're represented based on the volume activity that we can see on the option chain. And hopefully this is a new concept to everybody. Is it something new, or should I go into a little bit more?
On the resistance and support, again, how did you determine where they are based on the charts?
Good questions. So for example, in this particular case, right, you can see a high value on the gamma volume.
Yeah.
See here?
Yes.
Much larger than anything else.
That's right.
Okay, now what that really means is we multiply the gamma or the vega value with the volume. Okay, it's a very simple equation they can do on TOS yourself.
Gotcha.
Now that value obviously shift along with the market sentiment. Like just like any time your trading range or the support resistance range changes with the market sentiment. However,
so at any instant, those numbers are changing.
Yeah, at any particular point in time, you should always see some kind of support and resistance most of the time. Gotcha. Okay, gotcha. And the reason why they formed. The reason why the gamma wall or the support resistance form is because a lot of people are willing to sell you and get the premium at the support for the put, right? Because if it doesn't breach the low end of the price, then it means that they are collecting all the premium. Does it make sense? So that's what this option seller do. And similar in reverse, people willing to trade more or sell more on the call side when they see an opportunity to take profit or gain the premium on the price where they think the market will not go exceed that price. Does that make sense from a psychology standpoint? More people willing to trade or sell a premium at the low which they think will not breach, which thus become a support. People are willing to sell more. Please.
Sorry to interrupt. On the bid and the ask on the support, is that normal to have such a gigantic difference?
This is close.
Must be after hours, right?
Yeah, this is after hours. So yeah, don't worry about it. It's, unfortunately, I have to do this presentation after hours after the.
Right, you don't want to do it while you're trading.
Yeah, so I have to write my presentation afterward.
Good. I'm glad I noticed that. I was like, whoa, that is like, if that's normal, then it's not very liquid.
No, it's not that. It's also this is the ES, so SPX will have more liquidity and the SPY have much more liquidity as well. Sorry. Yeah, but I just want to use as an example so you can understand what I'm trying to elaborate. Okay.
So, hi, can you repeat? So the gamma volume on the call side is not high, right? It's just 48. Which number are you looking?
So yes, 48. So it's a relative number, right? So if 48 is larger than anything else. Does it make sense?
Okay.
Yeah.
Okay. Oh, it's much higher on the
Yeah.
side of.
Yeah, this is OI. This is real time. So don't look at OI. OI is based on open interest. So that may be like traded or the previous own volume at that price point.
Okay.
Yeah.
Thanks.
Okay.
Is your focus mostly on the gamma volume or the Vega volume?
Gamma volume. Well,
Yeah.
essentially they should always correspond to the same thing.
Yeah, they go hand in hand usually.
Yeah, they should. So, but I just separate them out just in case I see some off chance they are not the same. I don't want to count on the fact that they are 100% chance the same all the time.
Right.
Okay. Okay. So basic concept, at least you guys understand, right? Now, so let's get back into say support and resistance, and this is to show you that the support changes with time during the trading day. This is last Friday. You can visually see that the support changes, right?
Newport Beach, California.
Yes.
Okay. Okay. So during that time, I have a scan list to help me understand what are the quote unquote support and resistance areas sold by the option market based on picking up basically the high Vega volume areas of the zero DTE trade, right? Essentially for me, I just look at say which one has a higher volume traded and be able to filter based on the volume traded to see where are the potential support and resistance area. And I use those to help me identify the trading opportunities, right? Because I go into the psychology behind it later. Okay. So we understand the whole support and resistance. That should not be new.
Mm-hmm.
Okay. So zero DT reward versus risk. Let's see. Maybe I should go into the psychology first. Okay, the psychology of the zero DTE trade is this. We understand that the market mostly are sellers, right? However, at the last day of the trade, what would the typical option trader do on the last day of trade? Does anyone know? Most of the trader were likely to close their trade from a professional trader's perspective, right?
Mm-hmm.
Okay. So what that really means is there's opportunity, and we understand, right? When people wanting to close a trade, if it potentially going against their positions, then they would want to close the trade, which means that they sell it, they now become buyers. If there's buyers, there's buy volume. If there's buy volume, likely is going to push the price higher. Agree?
Yeah.
Okay. So the opportunity for the zero DTE trade is to identify where is buy volume started to happen that coincide with the direction of the price. And we are trading based on the Vega volume because those are the area, or looking at the OIs, because those are the areas that has the highest traded volume, which means that if people were already selling those prices, if they want to close their trade, they're likely to close their trade during because they already had a lot of positions sold, right? And they need to close their trade, they need to buy it back, right? So our goal is trying to take the opportunity of those buy activities during that time. And we identify the opportunity by looking at buy volume and versus sell volume. So if there's a buy volume exists on the call, for example, we should see coincidentally the sell volume on the put side. If we see buy volume on the put side, we should see sell volume on the call side. Make sense? Right? One is the inverse of the other. Okay.
Mm-hmm.
Now, so the reason why I go into the psychology of it, so you can understand based on the overall situation from the beginning of the zero DTE trade, where people are trying to close the trade, till the end of session, where the time start to decay on the option. And if it doesn't breach the support and resistance area, then you're going to see a quick decay in the put or call options. Now, going back to price, so if a price is going down on the market, is going down, then obviously we want to look for a long put opportunity, right? Because there may be a lot of people who bought call at that time thinking that price goes up, but price instead went down, and the put side, right? Put side may see more buy volume, and the more people wanting to sell, people who were long call wanted to sell the call, then vice versa. So we see an increase in the put price, and if the price goes down, inversely, if we see the price goes up, we see the price of the call should go up. But when it get near to the resistance area, then we see people are selling off the calls, and where you see a huge quick decrease in the price of the calls, right? And you can observe all this from a volume perspective. And just so you know, just to share with you guys, I typically observe roughly about 50% to 500% price change during that time. So that's why people are so fascinated about 0DTE, because they see this is the easy way of getting a huge percentage. And that's just what I've seen so far.
Some people refer to it as a lotto trade.
Yeah, but again, if you already know the answer to the lotto numbers, then it's not really lottery. So that's what I'm trying to get to, right? Something to keep in mind, right? Because with anything, I don't know how many of you actually observe your liquidity of the trade, right? But for me, I always very cautious when I look at the amount of volume I'm injecting into the market and try to take out. So for me, I would say set up a rule to say don't trade above 100 contract. You may not be able to get out, right? Especially you're doing a long position, and maybe even optimally try to do 10 contract at a time, and then that's give you a more certain way of making sure you can get out easily. You can probably do more.
The ES, the MES, or is this for anything?
Mostly we look at SPX, and I'll explain later what that is. Was there any questions? I keep on seeing like new messages on the.
It's me posting the agenda.
Okay.
When a new person comes in, they got to get the agenda before.
Okay, no problem. All right, so we understand the psychology, why people are trying to close the trade, why it's creating buy volumes, why there would be an opportunity to see uptick in the option price versus when time to decay out, and making sure that you want to get out before that it starts to decay quickly. Okay. So overall strategy is very simple, right? We essentially look at three things. One is from a pricing trend perspective, are we looking at is an uptrend or downtrend? Number two is, are we looking at is their buy volume or their sell volume, right? Number three, we look at the options side. Is there buy volume at the call side, not overbought, right? And are there sell volume at the put, right? Everything should correspond correctly to the same picture, right? It's like they all should align together. There are situations where they will not align. There are situations where they will not align. Keep in mind, right? Not everything is going to be just going up or going down. Sometimes they go sideways. Sideways because things are not aligned, right? So we only trade alongside when everything is aligned, okay? So in that case, like for example, you just buy call and sell put, and inversely with downtrend, sell volume on the ticker on the ES, then we're looking at buy put and sell calls. We only focus mostly on the SPX0DT, which I will go into next. Sorry, here. Okay, so this is the Ron's question as to why SPX versus SPY, right? So I think those are the key things that people are looking at. Number one, what are the spread look like? The reason why people care about the spread is because the larger the spread, it's likely that you'll not be able to profitable unless you have a larger price movement happening, right? If you have a small price movement happening, then you could just lose money based on the spread that when you trade. Number two is cash settlement, because you don't actually get assigned with shares. SPI have shares that can get assigned. There's tax advantage of using SPX trade based on the 2021 IRS rules. I'm not a tax advisor, but just share with you the information I can find. Okay, and
40 rule, right? And the same applies to the ES.
Exactly, but the key thing is, are you going to get the level of the returns on ES versus
SPX?
Exactly. SPX options, right?
But I would think the ES options are far less liquid than the SPX options.
Oh yeah, ES is far less. Yeah, ES for certain is far less. Now on the extended hours, because SPX is only traded during the market hours, so there is no extended hours. So what that really means is that if you anticipate the market to go up because the after-hour earning, for example, Tesla, Nvidia, Apple, and so on and so forth, then you can't just let's go buy SPX code, because that thing is going to expire before the market ends. So
now Jay told me that they even he's with one of the other brokers where they let you do SPX options from midnight.
Yeah, they are
opening things up in some places.
I would not recommend it, honestly,
because it's not liquid, right?
Yeah, number one, it's not liquid. Number two, your spread is going to be very high. Number three is, the volume more than often is not 100% certain yet. So which means that you actually, if you're going for a long position, you're going to see a huge decay regardless which position you take. So from experience perspective, I would just say you don't need to, right? I mean, besides, in the midnight, you should be sleeping. Why are you trading at midnight? Personally speaking, sleeping is more important.
The London market, it opens up. So
yeah. So my experience is that it's better just trade when the market opens, and that's what I've been doing. And just because the price movement, when there is huge volume, you can see and have certainty that it's going in certain directions. Then if you just randomly try to take the opportunity, like pre-market doing a 1 DTE or like pre-market 0 DTE, then you're going to suffer significant decay, or psychologically you also face a lot of uncertainty while you're not able to sleep much. That doesn't do too well for the personal health.
Another thing I like SPX is that it also will let you continue trading until 115.
Mm-hmm.
So if you're
but that's only if you wanted to do things like aftermarket, that there's an ER and this going to pop up, and after that you're going to try to sell off your position.
You don't want to enter your trade after 1 o'clock, but you want to exit after 1 o'clock.
Exactly.
If you're really a fan of trading 24/7 and not get any life, just trade the ES itself. Why the options?
That's true. Well, the option has its advantages. It's cheap.
Well, there's a multiplier situation. Okay, so back to what we're saying, right? I show you the overall strategy concept on to when to trade what, right? This is the example of using signal to help verifying the situation, right? So we can see when it's an uptrend, there's a buy volume, and all this line align to the same exact time. This is 1 minute time period, right? 1 minute time period. So that at this point there is merging into buy volume, and it start going up. I put some indicators on the TOS to help me to identify potential reversal situations. So psychologically, I know when to prepare myself to exit the heck out of this position, right? The overall price points is aligned with the price movement of the underlying, mostly with the ES. However, by looking at the volume activities, you should be more aware when to get out, because you don't want to stuck to a certain point that, yeah, the price move up to the highest point, but there's nobody, on the other side to take the trade. Then you're like, you're stuck. So don't do that, right?
There's a question for you in the chat.
Oh, there is. Sorry.
What do you use to see if something is overbought or not?
Oh, that's easy. So overbought, I use things like theoretical option price, right? So theoretical option price is tend to be the optimal price. This is signified on TOS by this purple line here. And
Theoretical value is what you look at, right?
yeah, theoretical option value, they tend to be an area where you need to be cautious and there will be an overbought situation.
Gotcha.
Yeah.
Can you please go back to the last statement that you were on the chart where if you want to buy, but there's nobody on the other side? I just got something here. I had to switch off and I didn't hear you.
Right. So as you can see from a volume perspective, right, this is the huge,
volume.
huge buy volume in the beginning. Then you see people start to selling off over here, right? So keep in mind, like when you get to this point where there is a top of reversal, right? Is there anyone going to buy from you at that point? That's the question, right? So it's like, the good thing is, if you look at the price, right, we identify buying opportunity roughly about 3.5 over here. At the first reversal, we're looking at roughly about 7.5. You already double your money at the time. Does that make sense? So the only thing I'm just like, the general right thing to do, just don't be overly greedy, because like when you try to push to the boundary point, there's nobody else the other to take your trade.
Right. So what you're saying is based on your entry, have the proper tier exits, not that on the pivotal point there may be no buyers, because I do see some volume. It's just an opposition. If you have a runner, that's great, but you don't even have to.
Yeah, you don't really have to. Just don't be overly greedy. And the key thing is that you be able to trade in the morning, and keep in mind, right? The inversion point to buy is at 8:14 a.m. Pacific Standard Time last Friday. Like this is the diagram I captured along for last Friday. We can see that this is where the opportunity is at as of Friday, right? So also keep in mind, right? Remember what we said. The option price is dictated by the 0DT option price dictated by three things, right? The Vega, Gamma, and the Delta. So if the price of the stock start to not moving up much, you're going to see a huge drop in the option price. Make sense? So don't try to, the stock is going to go all the way up to X, so I'm going to wait for the option to near expiration, and you're going to see a huge decay in that situation. Don't do that. Just why, right? I mean, if you can make double or like 2.5 or 3x of your money in less than 1 hour, just take the profit. Don't be greedy. Okay.
Yes, and particularly from my experience, the moment you enter the trade, if you're correct, the price goes up pretty quickly.
Yeah.
So once it starts stalling, you may want to be out if you already have decent profit.
Yeah, so I have all this inversion point based on the trading volume and the candle pattern and so forth, right? To help me better identify situation where the market starts to see reversals. Because then the reason why market is seeing reversal is because at those price junctions, people don't have the necessary confidence that the market can accelerate upward, right? Remember, there is the gamma component into the option value, right? So if it's not accelerated up, then the price is likely to retract. Okay, so that's where the important thing is. So the reason why I show you all these three is so you understand that the price of the option doesn't always align with the underlying, and people have this illusion about, hey, you know what, stock goes up, my option price should go up. It doesn't go that way. So I just want to remind you guys of that situation.
So in that chance, so where do you enter how do you enter? You see, it's not overbought. It's totally there's a volume increasing. So
Mhm.
you buy the option there.
Yeah,
But-
so this is where I would enter. It's like number one, I check, hey, it's not overbought. Number two, I check this buy volume. Number three, I check this also corresponding buy volume at the same time with the ES and making sure the overall trend is supporting upward movement. That's where I looking at the buying the call.
Okay, so you're looking first bar on the buy volume on the ES because it's not yet started having those green bars yet, right?
Say what? Sorry.
So you don't see that many green bars yet, right? So you're just buying on the first green bar,
Yeah.
the buy volume.
Yeah. Once it converts into green bar, then I needed to, yeah. And the key thing is be able to identify the right opportunity, right? Don't try to trade against the trend. That's what I'm saying, right? Don't try to trade against the market volume. If the market volume is showing like there is nobody buying, right? Like don't like jumping and say, well, I'm just going against the market. So that's what I'm saying. Like you needed to see alignment in basically the overall price trend, the overall volume, and the option volume. Like they all have to align.
The
Makes
trend
sense?
is your friend.
Trend, yeah, trend. Well, yeah, but it's more than just trend, right? So
Right.
yeah, okay.
Thanks.
Yeah, so this is why I stream every day, right? I stream this to people who use my services to help them align like the call option, put option, call option volume, put option volume, then ES candle, ES volume, NQ candle, NQ volume, right? The reason why I do this is because a relative small movement on ES can be a huge percentage difference in the option price value. So this way, I can use this approach to quickly trade options and get in and get out, right? Because the time window, sometimes the window is so short. Sometimes, like, for example, if you look at the last week, Friday, right, we can see the 5125 calls goes up from, say, $11 to, say, 20. Like, it's a matter of less than 30 minutes or even 15 minutes, you get doubling the effect. So, the question is that, you know, if you're trading options, then because that quick price change effect, you don't want it to there's no point waiting that long, right? And you see, because you see how the I don't know if you guys see this, there's a like kind of a dark red inversion point, and then you can see that those are the overbought signal telling me that there's a reversal happening. So I can tell that, hey, you know what, it's time to, like, in here it's better to do a seller at this point. Yeah, so if it's overbought, there's you know, you want to be mindful that you want to be a seller. If it's not overbought, then you can be mindful to be a buyer. So that's kind of the overall situation. And on the left, I have a bunch of ticker scanners that help me understand what is the market doing right now, what is market chasing, right, and so forth, and if there's any kind of option where activities going on.
Question.
Mm-hmm.
The purple line under call option, is that the theoretical value?
That is the theoretical option value. You guys can look up on the POS. Yeah. Pretty easy. Just quick things. Anyone want to join my Discord? Feel free. It's just AlgoClub. I also put YouTube on there. If anyone is interested to follow me on YouTube. Okay, that's pretty much it. I hope that give you some insight to correctly trade options on 0DTEs. Yeah.
Can you put that Discord link in the chat or somewhere?
Okay, sure. Well, I'm let me type it in then. Discord. AlgoClub. Yeah. Cool. Did I run out my time? I think I scheduled 45 minutes.
You still got time.
I'm sorry.
No, you overestimated your time usage.
Yeah, I think I overestimated. But it's all good. yeah, I don't have anything else. I just want to make sure that you guys, understand the in and out from both psychology standpoint, where there's opportunity, how to measure the risk, making sure, you don't just trade willy-nilly, right? You have to observe a very specific situation. They all have to align before you take the trade. That's all. Yeah.
You might want to explain to folks that are kind of new to options, do like a rough and dirty, like what is a put and a call, and when is it better to sell a put or a call, or when is it better to buy a put or a call?
Yeah, from a zero DTE perspective, right, it's better to be a premium seller when it's overbought, right? And when it's overbought on reversal, then it's easier to be option sellers. And in the reverse, if it's yeah. So that's actually easier than done. In terms of what is a put and call, well, a call essentially is just a contract that you anticipate the value of the underlying stocks will exceed that particular contract strike value. So for example, if you buy a call at say 5010, right, and the underlying SPX went up to say 5100, there's a $90 spread which become the cash value on settlement, right? So if you buy a call at 5010 for a price of $10, right? So which means your cost is 5020, and it end up that at the expiration, the price of the SPX went up to 5100. So there is total a profit of $80. So that's essentially what a call is, in simple terms. Yeah.
And then a call is when you're bullish, and a put is when you're bearish, when you're buying.
Well, that's oversimplification. That's the problem. I didn't want to. Yeah, because you could do a long call, you could do a short call, right? And you could be doing a short in the money and out of money, and it depends on how you took it. Like you can't. I see a lot of people just oversimplify like that. And like, oh man, don't do that, because it's not quite like that. Yeah.
There's a question in chat for you.
Okay, sure. What was the question? What exactly the theoretical option value in terms of being over? What is the math behind the theoretical option value? Oh, why is using theoretical value a good way of determining?
Yeah.
Okay.
Like, how do you determine, looking at the theoretical value, whether it's been
okay, so I don't use theoretical option value to determine oversold. You can't determine oversold on that one. But the reason why I use theoretical option value as a potential overbought area is because that's what I've been observe been trading, and see that when it's near at the theoretical option value, which is the maximum of what the option value should be at that point in time, then it's likely to be an overbought situation. That just like when you trade enough time, you see it happening again and again. Just that's why, yeah. So I start use that as a reversal pattern. Like when there's a potential reversal situation happening. Yeah. And it just helped me to determine whether I want to be a buyer or seller.
So if this price is higher than the theoretical value, then
exactly. You don't want to be like it doesn't mean that the price cannot go up further. The problem is you're not going to see that significant gain. Like there's no point. Actually, on Friday when I on Clubhouse, I was talking about this one. I use that as an opportunity to explain to the audience that, hey, you know what, like this is area you want to be very, very careful, right? Because you could try to be on that side of trade, but hey, you know what, like it more likely it's going to decay faster than you then you have a chance to get out, right? So looking at the Friday situation. looking at Friday situation, right? There's a buy volume at the beginning of the market, right? And then there could be a buy like few tickets up on the call, but the problem is like it's quickly went down. Not this one. Let me see. Use that. Oh yeah, use this one. Yeah. So it went up quickly, but it went down pretty fast, right? So like you could, but is there a real value for you doing that? So, just like again, it's doing any trade, two things, right? Understand your risk, and just don't try to be overly aggressive, right? If you're buying at the theoretical value, to me that's overly aggressive. There's no point doing that. There's a lot of opportunity in a day. Like based on what I say, there's a lot of opportunity in a day. You don't need to stuck yourself into one particular situation. That's what I'm saying. Okay. All right. Hopefully today was good. I know, Ron, you need to. Is it right now? Wow, 4:51.
Getting close to the wrapping up time.
Okay. Yep.
Are there any other questions? Cheng, thank you very much for your presentation.
No problem.
Thank you.